Hello traders, welcome to the Smart Risk. Usually, we place our orders at important levels in the chart. We buy in the demand zone and sell in the supply zone. But what if these demand and supply zones are not important enough to place a trade? Probably we will end up losing if we execute a trade on them. So identifying important levels in the market is vital. In this episode, we will cover one of the most powerful demand and supply zones called order blocks. We will show you how to draw order block zones in the chart along with the rules to identify valid order blocks. Let's get started. So what is an order block? Order blocks are the optimized areas of supply and demand. Order blocks form when central banks or large financial institutions accumulate large quantities of a particular asset through big orders, resulting in a massive price move. In other words, they form when there is an imbalance between the buyers and sellers in the market. And why are order blocks important? Because whenever the price reaches them, we can expect the price to show a significant reaction to them. In the bullish scenario, the last bearish candlestick before starting a drastic bullish move will be identified as the order block zone. Or the first weak bullish candlestick before the start of a drastic bullish move. The same thing applies to the bearish scenario. So, let's look at these examples and see if we can identify the order blocks. Here we have a heavy bullish uptrend. And you can quickly point out the drastic moves caused by the market imbalance between the buyers and sellers. Look and see if you can spot the order block zones by definition. The last bearish candlestick before starting a heavy bullish move, or the first weak bullish candlestick. Here, we see a bearish candle before a big move, so we point it out. Here, we have a weak bullish candle before a big move, so again we highlight it. Again, a bearish candle before a big bullish move. And the rest, just like the others. Keep in mind that, whenever the shadow of a candlestick is bigger than the rest of it, we take the shadow as the zone of our order block. So far, you have a vision of order blocks, but here is the key point. Order blocks must meet 4 rules to work effectively. And those rules are having imbalance, break of structure, inefficiency, and being unmitigated. We have already discussed the imbalance. Let's talk about the other rules. Breaking of a structure. Take a look at this example. Here the price made a move to the downside, made structural level and had a pullback on the way down. We can notice this move with imbalance, but we can't identify this level as an order block because the price never broke below the structure. So for having an order block, price must break through the structure. Rule number 3. Inefficiency. Take a look at this example. If I only draw the body of candles, we have the same heavy bullish move to the upside. But see if you can notice the difference when I add the shadows. In the first case, the price went up to this level and then pulled back here and gathered all of the orders that have been waiting for a pullback. So if we identify this level as an order block and expect the price to react to this level, it will have minor chance to work, because there exist no orders since all of them have been gathered before. But look at the other scenario. If someone were waiting for a pullback, they would have missed this trade, so on the way back, everyone is waiting to place orders in the demand zone. This is the concept of inefficiency. Let's talk about the last rule, which is so simple. The order block must be unmitigated. Order blocks are one-time use, so if the price has reacted to an order block before, we won't consider placing a trade on it. Therefore, the order block must be unmitigated. So that's it, traders. Thanks for watching. Please support us by like and subscribe, and comment down below if you have any questions. See you in the next episode.